Monty Bennett of the Ashford Group of companies, founder, chairman, and CEO. Nice to see you at the Global Conference here in LA.
Thanks for having me.
You are in the hospitality and leisure business. You've got hotel properties everywhere. How's the economy doing based on what you're seeing with your own properties?
We've got about 140 properties nationwide, and we've seen strong growth in demand since the Great Recession. But here over the past few months, it's gotten a little bit choppier. We're seeing different regional variances. You have areas like Houston, which is suffering greatly because of the oil market. You have the West Coast, which is very strong because very little new supply is coming in. And you have New York City, which is also suffering because of the large increase in supply, a strongish dollar, the impact of Airbnb on the marketplace. So it's different for different markets, but overall, it's been choppy these past few months.
Do you have in the industry right now pricing power? Or not?
In some markets we do. In those markets that I mentioned, we definitely do. We converted a Crowne Plaza hotel here in Beverly Hills to a Marriott hotel after an extensive renovation. And we've seen revenues grow 90% year over year. It's been absolutely extraordinary as that market really craved that kind of product. In other markets, especially those markets that I mentioned, pricing power is non-existent, and it's difficult to hang on to rates.
Interest rates. We did see a little bump up in rates. Are you impacted, and what are your expectations for how moving forward it might impact your business?
We are a little bit impacted by rising interest rates. With $62 trillion worth of debt in this economy, I think it's very difficult for the Fed to raise interest rates very much, right? 1% equals $650 billion, which is pulled from borrowers who are spenders to the savers who are the lenders, and that'll have a very destimulating effect on the economy. And in fact, I think that once we hit our next recession, whenever that may be, we might see interest rates not only go negative, but go negative in a material way. I think that's the only way that the Fed is going to be able to push all the savers to get rid of all the cash on hand and to put it out into the economy and get it to work. And the trade is that if they don't, then it'll be taken away from them through negative interest rates.
Although it's interesting because certainly other countries have had this experience, we have not in the U.S. What would that mean from a business perspective? How do you hedge for negative interest rates sometime down the line? The recovery is actually getting old in historic terms. Doesn't feel like it, but it is.
It is getting old, and if you're a saver, if you're in cash, then you won't be in a good spot. If you're in long-term bonds, especially long-term treasury bonds, 10-year bonds, those rates would drop too. You'll do very, very well. So from an investment standpoint, you've got to be very careful about what assets you own going into the next recession if rates go negative.
And what about from your perspective? For instance, have you borrowed more since rates are low for any sort of capital expenditure?
We've borrowed, and we also bought some protections in the form of interest rate floors. We've got quite a bit of notional amount, billions of dollars of notional amount of interest rates floors, which will pay off as interest rates go negative.
Monty Bennett, it's been great chatting with you today. Thank you so much.
Thank you.